So this is a big topic because it has a lot of depth to it, and it's a very important strategy to understand, but it also is important to understand the nuances that goes into it, such as the tax consequences, the costs of doing so, and the overall strategy behind it. So first of all, what is a refi or a refinance? So this is basically when you originally bought the property. Let's just use a simple example, a $10 million property with a $6 million loan. And then over some time, because of the market going up in value, your rents are higher, you did a business plan where you did some renovations, you increase the value of the property. Let's say the property value is now $15 million. And so you can go and get a new loan now at a higher amount than your existing loan, which is going to be able to not just pay off your existing loan, there's going to be excess capital above and beyond the payoff of your existing loan, and that's going to be considered cash out proceeds. So this is the dream scenario when people talk about refis. They talk about a cash out refi, and that in itself is the strategy, right? Typically people don't romanticize or strategize about cash neutral refinances, or even worse, cash in refis, which is maybe another topic that we might cover. But with a cash out refi, like I said in the example, you started out with a $6 million loan, and let's say you put on a $10 million new loan on the property, you're going to have $4 million of excess capital. Now, that's not quite exactly true because you are going to have closing costs. And so it is expensive typically to pay off a loan, and it's also typically expensive to put on a new loan, right? Financing is just expensive. There's closing costs, title fees, there's broker fees, lender fees, due diligence costs, inspection costs. You know, everyone's got to get a piece of a big refi. Just to keep it simple, like that $4 million of cash out proceeds goes back to the partnership. And so in the context of a private syndication, we would take those cash proceeds and distribute it back to investors, and investors would have a big win because they would be able to get some of their capital back, some of their original investment back, but they're not being diluted, so they don't actually change their ownership percentage in the deal. There's no downside here. The upside is, of course, you get some of your capital back, so you value the time value of money, you get your money back. The other valuable element of a refi is that it is not taxable, because when you are getting cash back through a refi, that is debt financing, and so debt is not income, so it's not taxed. So this is something that people really love. You know, people in the zeitgeist right now like to talk on Instagram about how, oh, the rich, they buy, then they refi, they never sell, they hold forever, and this is how the smart rich people operate, and this is definitely true to an extent. But of course, there's more complexity when it comes to estate taxes and trusts and things like that to really make it happen. But refi is a powerful strategy where you can be more tax efficient than buying, selling, and just in general, holding longer term can really allow you to compound over time more efficiently